Time value of money, EOC end of chapter questions. Question number 1. The table below gives current information on the interest rates for 2 years and 2 8 years maturity investments, 2 years and 2 8 years and 1 7 years maturity investments. The table also gives the maturity, liquidity, and the default risk characteristics of the new investments possibility. We have been given 5 different investments. 2 of them have a maturity of 2 years, and the investment 4 and 5, they have maturity of 8 years. And there is one investment that is under consideration, investment 3, that has maturity of 7 years. Alright. All investments promise only a single payment, a payment at maturity. Assume that premiums relating to inflation, liquidity, and default risk are constant across all the time horizons from 2 to 8 years. Based on the information in the table given, address the following areas. Number 1, A. Explain the difference between the interest rates on investment 1 and investment 2. Now, this is your investment 1 and investment 2. They have same maturity, 2 years. They have same default risk. The difference between investment 1 and investment 2 is because of liquidity. Investment 1 has high liquidity and investment 2 has low liquidity. So this is the only difference, and this difference is being reflected here in the interest rates. Everything else is same, maturity is same, default risk is same. So if investment 1 is highly liquid, it has interest rate of 2%. Investment 2, which is relatively low in liquidity, it has interest rate of 2.5. So the only difference that can be justified in the given circumstances is liquidity premium. This risk, because of low liquidity, has resulted in 0.5% premium. So this 0.5% represents liquidity premium that is being offered for investment 2. So that makes 0.5 to be the answer. It's not basically a multiple choice question, so we just needed to understand the idea. This 0.5 represents your liquidity premium for your investment 2. Next, estimate the default risk premium. Okay, default risk premium for investment 1 is low, 2 low, 3 low, investment 4 low, and investment 5. So this is an investment that can help us calculate the default risk. Now compare these two together, investment 4 and investment 5. Both have maturity of 8 years. One has high liquidity, another is low liquidity. One has high default risk, other has low default risk. Now let us bring them on equal basis. Now let's say if investment 8 had low liquidity. Because of low liquidity, it has to have 0.5% liquidity premium added. Thereby the return on this investment would have been 4.5%. Now converting this investment from high to low liquidity, the interest rate has to be increased by liquidity premium of 0.5%. So this makes the interest rate on investment 4.5%. Now the only difference between these two, maturity 8 years, liquidity low. Now the only difference between these two investments is default risk. One has low default risk, other has high. So the difference between these two, 4.5 versus 6.5, this 2% difference represents your default risk premium. That's all. C. Calculate upper and lower limits for the interest rates on investment 3. This is your investment 3. It has low default risk. It has low liquidity risk. It has low liquidity, so be compensated with liquidity premium, and it has maturity of 7 years. Since it has low default risk, it has to have, and it has low liquidity, so the return on this investment should be more than 2.5 in order to compensate for low liquidity. So it means the return for this investment should be greater than 2.5. Now, since it has low default risk, we already determined for this particular investment for the return to be 4.5%. So since this has a lower maturity period of 7 years, So it has to have a return of less than 4.5%. So it means the return for investment 3 has to be greater than 2.5 and it has to be less than 4.5. So it means the return range for investment 3 has to be greater than 2.5 and less than 4.5. 2.5 greater than 2.5 because it has low liquidity, and less than 4.5 because it has a lower period of maturity. So that gives the range between 2.5 to 4.5. Next, a couple plans to set aside $20,000 per year in a conservative portfolio projected to earn 7% a year return. If they make their first saving contribution 1 year from now, how much will they have at the end of 20 years? Timeline has already been drawn for you. You just need to put things in order. This is your first investment, second, and it will continue till the end of 20th year. It means the period that we need to compound n is 20. Interest rate is 7%. Present value is 0. We need to calculate the future value. So, and the payment every period is negative 20. You just have to calculate the future value, call your calculator function and plug in the numbers to get your result. N is 20, interest rate 7, present value 0, payment every year is 20,000. So compute future value, it's 819,909.846. That should match with the result given. These are all questions extracted from your curriculum, end of chapter questions. So I think this is given here, 819,909.85. Simple, straightforward question. Next, 2 years from now, a client will receive the first of 3 annual payments of 20,000 from a small business project. These 3 payments coming from year 2, 3 and 4. If she can earn 9% annually on her investments and plans to retire in 6 years, at this point, how much will the 3 business project payments be worth at the time of her retirement? So basically, you will have to calculate the future value of these 3 investments till this point and then reinvest it for the next 2 years to find the future value. It's given here. These 3 payments of 20,000 each. First, we need to calculate the future value and then need to reinvest it for the next 2 years to find the final future value for this period. Let us calculate these. Also, let us first lay down the numbers we need. For these periods, we have 3 payments, N is 3, interest rate is 9, interest rate per period, present value 0, the periodic payment is negative 20,000. We need to calculate the future value. So we just enter the data in the financial calculator to get our result. 3 is N, 9% interest, 0 present value. Every payment is of $20,000. We need to calculate the future value. This future value 65,562. This is the future value at the end of year 4, 65562. Now it needs to be reinvested for the next 2 years in order to find the final value at the end of year 6. So what you will do simply, this is what we have as a present value. Now this will serve as a present value. 65562 is now the present value that will be compounded for the next 2 periods at 9% interest, 2 periods, 0 payment, and it will give you the future value, that is 77894.21, perfectly matching with this result given here. So if you draw a timeline for a question like these, it will become very easy for you to manage these questions. Here we go. To cover the first year's total college tuition payment for his 2 children, a father will make $75,000 payment 5 years from now. How much will he need to invest today to meet his first tuition goal if the investment earns 6% annually? Timeline has already been given. What you need to do, you need to calculate how much he has to invest now so as to receive this amount in the future. How many periods are involved? There are 5 periods. What's the interest rate given? A straightforward question. Interest rate per period is 6. Present value is what we need to calculate. This is what we need to find out what he should invest now. The future value, this is FV already given. And interest rate is given as well. There is no periodic payment, so it means the periodic payment would be 0 PMT. You will just have to compute the present value and you will get your result. Let's do it. N is 5. Interest rate is 6. Present value is to be calculated. 0 payment. Future value that we want is $75,000. And simply compute present value, that is 56,044. That perfectly matches with the result given. This is what would be the inflow right now, 56,044. Next, a client can choose between receiving 10 annual $100,000 retirement payments starting 1 year from today, or receiving a lump sum today. So he has two options. Either he receives $100,000 yearly for the next 10 years, or receive a single lump sum today. Knowing that he can invest at the rate of 5% annually, he has decided to take the lump sum. What lump sum today will be equivalent to the future annual payment? He wants to go for a lump sum, so this $100,000 payment every period, after every 1 year, it's worth what in the present terms. So there are 10 periods. Interest rate is 5. Regular recursive payment is $100,000. Future value is 0. So what should be the present value of these recursive payment for 10 years? Straightforward questions. Punch in the numbers, you'll get your result. 10 periods. 5 is the interest. Periodic payments that he wants to calculate for is $100,000. 0 is the future value. Compute present value, that is 772,173. Now, what this question is all about, that either he goes for $100,000 payment every year or 772,173 right now. He's indifferent because both of these are equivalent in time value of money concept. Either he goes for this amount right now or $100,000 at the end of every year till the next 10 years. So that gives you 772,173 as your correct option, which should be given right here. Next, you are considering investing in two different instruments. The first instrument will pay nothing for 3 years, but then it will start paying $20,000 per year for the next 4 years. Okay. The second instrument will pay $20,000 for 3 years and $30,000 in the 4th year. Okay. All payments are made at the year end. If your required rate of return on these investments is 8%, what should you be willing to pay for the first instrument, periodic payment, and what you will be willing to pay for the second instrument? Use a formula for 4 years annuity, or you can do any way you want to. You're not forced to exactly use what it says. You can use your convenient way to calculate. Now we need to calculate the future value. Right. In the first case, there are no payments in the first 4 years. Is it? The first instrument will pay nothing for 3 years, but then it will pay $20,000 for 4 years onwards. So basically we can calculate this using, do we need to calculate the present value or the future value? What should we be willing to pay for the first instrument? That's the present value right now, and for the second. So we need to calculate the present value for these two investments. Right. So we can do this using our NPV function. For the first year, there is no cash flow, enter, down arrow key. No cash flow for the second year, double down arrow key. No cash flow for the third year, no cash flow. This is year 1, 2, and 3. This was year 0. So this is your third year. But in the 4th year, you will receive $20,000 and you will continue to do so for the next 4 years. So frequency of these cash flows is 4. I'm sure you know how to use your calculator. So you will press NPV. 8% is the rate. Enter down arrow key and then simply compute, and you will get your present value, or what you will be willing to pay for this investment right now. So plug in the numbers and you'll get your result. 0 for the second year, first year end, 0 for the second, 0 for the third, But in the fourth year, we will be receiving 20,000, and this will continue for the next 4 years. Enter down arrow key, frequency is 4. Enter down arrow key, press present value, NPV interest is 8. Enter down arrow key, compute, and you get 52,585. 52,585. This is what you are willing to pay right now for an investment that will pay nothing for the first 3 years, year 1, 2, and 3, and then it will pay 20 in year 4, 5, 6, and 7. Right? So that is your result. You can match with your results given at the end of the chapter. 52585. 52585. What about the second one? The second one says that you will receive 20,000 in the first year, 20,000 in the second year, 20,000 in the third year, which means the frequency of these cash flows is 3. And then lastly, the last payment is for 30,000. That's in the fourth year. Enter down arrow key twice, press NPV, press the rate that is 8%, and simply enter and down arrow key and compute. You'll get your result. Let's do it. Your cash flow year 0. Then you have 20,000 payments with 3 frequencies, and 30,000 is for the fourth year. NPV at 8%, and you will get your result, which I believe should be 73,592. I think someone of you have calculated 73,592.83. All right, moving on. Let me reset my calculator first because we'll have issue again. Suppose you plan to send your daughter to college in 3 years. You expect her to earn 2/3 of her tuition payment in scholarship money. So you estimate that your payments will be 10,000 a year for 4 years. To estimate whether you have set aside enough money, you ignore possible inflation in tuition payments and assume that you can earn 8% annually on your investments. How much should you set aside now to cover these payments? So the question like these, if you draw a timeline, it will make much more easy for you to calculate. 0, 1, 2, 3, 4, 5, and probably 6 as well. So suppose you plan to send your daughter to college in 3 years, means that's the point where she will be enrolled in the university or college. And then you will have to make 4 payments of 10K each. How much should you invest now so that these 4 payments could be made at the end of year 3, at the start of year 3, then 4, 5, and 6? So this is basically an annuity question. What you will have to do, you will have to calculate the present value of these 4 payments at the end of year 2, and then from this you have to bring it back to year 0, and you're done. So what you will do, let me lay down the working. Use your calculator and get me the result. N is 4. 8, I'm doing for this part first. Present values to be calculated, that will be calculated at the end of year 2. This is what we need. Every payment would be of $10,000. Future value 0. Compute. Please do that. You should get 33,121. Correct. 33,121. So this 33,121, which is the value at the end of year 2, has to be brought to year 0. So you can simply divide it with 1. I think 8% was the rate. 1.08 squared. It will bring this to the present value, and that is going to be 28,396. So what did we do? First we calculated the present value of these 4 payments at the end of year 2, and then we brought it back to year 0 by dividing with 1.08 squared. So it's 28,396. Next, a client plans to send a child to college for 4 years starting 18 years from now. 18 years from now. Having set aside money for tuition, she decides to plan for room and boards also. She estimates these costs at 20,000 per year, payable at the beginning of each year. It's annuity due, but we can arrange it in the timeline. By the time her child goes to college, if she starts next year and makes 17 payments into the saving accounts, paying 5% annually, what annual payment must she make. Let us draw the timeline, discontinuous one, because we can't draw up to 21, starting from year 0, 1, 2. Since she will be admitted in 17th year for a period of 5 years, from 18 years, I think it was from the year 18, yes, 18, 90, 20 and 21. So these are the payments needed in year 18, 19, 20 and 21. These 4 payments are required in the 18, 19, 20, 21. What we will do, we'll bring these payments in the present terms through this TVM. We have N4, interest 5% per period. Present values to be calculated. This present value will be calculated at the end of year 17. Right? So N is 4, interest is 5, present value at year 17 is to be calculated. Future value is 0. PMT, every payment is for $20,000. We just have to calculate CPT and CPT for the present value, and you should get your result. It's going to be 70,919. 70,919. These payments brought into year 17 are 70,919. Now, we have to bring this to the present term. This is the cash flow at the end of year 17. We need to bring it to year 0. For this, we will have to do this working again. 17 periods. Interest is 5. Right? We need to calculate the payments to be made now. So this is something unknown. Present value is 0. And this is the future value at the end of year 17. It's 70,919. Simply compute PMT and you should get 2744.50. So this is the payment that she will have to make every month, every year, till the time year 17 and over. By that time, this amount will be accumulated, which will be sufficient enough to cover these 4 payments in year 18, 19, 20 and 21. Right? So that gives you 2744.50 as your correct option. So first 8 to 9 question little twisted, rest of them are very straightforward. Couple plans to pay their child's college tuition for 4 years starting 18 years from now. This is a good one. There is an involvement of inflation as well. A couple plans to pay their child's college tuition for 4 years starting 18 years from now. The current annual cost of college is $7,000, Canadian dollar, I guess. And they expect this cost to rise at an annual rate of 5%. In their planning, they assume that they can earn 6% annually. This is the rate you will use. How much must they put aside each year starting next year if they plan to make 17 equal payments? Now this question is interesting because this 7,000 Canadian dollar is in present term and there is an impact of inflation and that needs to be counted for. This is the annual rate of inflation. The cost will go up, which means that if you're talking from the point 0 onwards, the cost will go up 5% every year to year 17, 18, 19, 20 and 21. So starting from year 0, 1, 2, so on up to 17, 18, 19, 20 and 21. Now the amount right now in present term is 7,000. If you grow it at a rate of 5%, 1.05 raised to the power 18. 1.05 raised to the power 18. So this amount will be 16,846. 16,846 in the 18th year. This payment is right here. Then you need to multiply it again with 1.08. It will be 17,688. Multiply this with the 1.05 again. It will be 18,573. Multiply with the 1.05 again. It will be 19,501. So basically you have these 4 payments to be made in year 18, 19 and 20. And effect of inflation has been given. So what you will do, you can use your NPV function to calculate the value at the end of year 17, and then that can be used to calculate what needs to be paid every period or every year. So what you will do, let me write down the working. You have your financial calculators with you. You will write first cash flow to year 0, enter down arrow key, The first payment is 16,846. Enter down arrow key. I'm sure you are doing your computation side by side. 17,688. Enter down arrow key twice because it's a single cash flow. Then 18,573. Down arrow key twice. And then you have 19,501. All these future payments in year 18, 19, 20 have been entered. You calculate NPV by putting a 6% discount rate, enter down arrow key and compute. You will get the present value of these 4 payments at the end of year 17, which will be, I guess it's 62,679.49. Now this is the value at the end of year 17. What you need to pay in year 1, 2 onward till 17 so as to accumulate this much fund, so the fee could be paid for year 18, 19, 20 and 21. So basically this is your future value which you need at the end of year 17, that is 62,679.49. Now 17 periods, interest rate is 6%. Present value we are not interested in. We are interested in what should be the payment every year so as to accumulate this much fund at the end of year 17 so that the payments could be made from year 18 onwards. 18, 19, 20, 21. The payment of 7,000 that has been inflated at the rate of 5% across the year payment till the period 21. So when you enter all these, compute payments, so your payment would and should come 2221.66. So you just lay down your timeline, put the numbers in the right position and use your calculator wisely. You should get your results. Next, the nominal risk-free rate. Nominal risk-free rate is best described as the sum of real risk-free rate, and what? Nominal risk-free rate is real risk-free rate plus expected inflation. I'm sure you would have read the theory. It's simply nominal risk-free rate is sum of the real risk-free rate plus expected inflation. And then we have maturity and liquidity added to find the required rate of return. It was quite a straightforward question. Next, which of the following risk premiums is most relevant in explaining the difference in yields between 30-year bonds issued by the US Treasury and 30-year bond issued by small private issuer? Since the issuers are different, one is that you can rely on sovereign bonds, government is standing, Federal Reserve is standing at the back. So they have no risk and they are very liquid. They have high liquidity. The federal government, US Treasury securities are very liquid, but the securities issued by small private issuer, they will have issue of liquidity. So it means these two, difference between these is liquidity. Maturity is the same for both. Inflation affects both in the same way, but the difference between these two is liquidity. One is highly liquid, the other one will have lower liquidity. A bank quotes stated annual interest rate of 4% if the rate is equal to an effective annual rate of 4.08. This is your nominal rate NOM and this is your 4.08 is your effective rate EFF. Then the bank is compounding interest based upon what? Daily, quarterly, semi-annually. Let us test these one by one. First, do it for, let's extend the idea. Let us do it first biannually, then quarterly, then monthly, and then daily. It's hit and error, trial and error. You try the first one and then you move on. So in first, this is your nominal rate. Let us use your calculator to find out. Second, interest rate conversion, and the nominal rate second interest rate conversion, nominal rate is 4. Enter up. Frequency of compounding biannually mean twice. Enter up. Effective rate would be 4.04. But it is 4.0. It means we have to increase the frequency. Let us do it quarterly. For quarter, the compounding per period would be 4. Enter up. Effective rate would 4.06. Still not. It means it's not even the quarter compounding. Let's move on to the monthly basis. even it is not given. Just for the sake of understanding, monthly compounding means the compounding period would be 12. Enter. Up. 4.07. Then what is left now? We have done semi-annually, we have done quarterly, we have done monthly, we have done bi-annually. Now it must be daily then. So the compounding per period is 365. Enter. Now the effective rate is 4.08. So now it makes sense that the compounding is on daily basis. So that makes A to be the correct option. Right. Next. The value in 6 years of 75,000 invested today at a stated annual interest rate of 7% compounded quarterly is closest to, first of all, the compounding period is quarterly, which means if there are 6 years involved, they have to be converted into 6 times 4, 24 periods. Interest rate has to be adjusted as well. It's 7% compounded quarterly, must be divided with 4. 7 upon 4 will give you 1.75. What are we interested in? The value in 6 years of 75,000. This 75,000 represents your present value. There is no payment. You just have to compute the future value. Everything is there. You just need to punch in the numbers and you will get your result. And it should be what? I'm sure you would have calculated, some of you. C. 113. Correct. 113,733. Next, a client requires 100,000 pounds 1 year from now. 1 year from now. So that means it's a future amount. You can write here future amount 100,000. If the stated annual rate is 2.5 compounded weekly. When it says compounded weekly, you need to divide it with 52. So 2.5 divided with 52 gives you a very small interest rate, that is 0.04806676. And how many weeks are there in 1 year? 52 weeks. So 52 weeks, interest rate is this. Payment is 0. This is the future value. What should be the present value? I'm sure you would have, smart people are there. So yes, exactly, that is 97. Good, very good. We are saving a lot of time. Okay, next is for lump sum investment of 250,000 yen invested at a stated annual rate of 3% compounded daily. Now there is a daily compounding. The number of months needed to grow the sum to 1 million yen. This is the future value we need, 1 million future amount. Payment is 0, right? And it says right now its present value lump sum is 250. That is negative 250. All right, how many periods this is required? 3% compounded daily. It means 3% divided by 365 gives you a very little rate, that is 0.0082192. Now gentlemen, you have PMT, you have present value, future value, compounding per period. Enter all and press CPT. CPT-N. What you will get is, you will get 16867.22. All right, so it's 16867.22 divided by 360, and then you can get the exact result A. 46.85 times 12, so gives you 555. All right, moving on. Marginal error of 360 versus 365. Given a 1 million investment for 4 years with the stated annual rate of 3% compounded continuously. The difference in its interest earnings compared with the same investments compounded daily is. Now let us do this question side by side. In one side we have daily compounding, and on the other side we have continuous compounding. I'm sure you know the formula, right? And on the other side, let's say take this, how many 3% is the rate, convert this rate on daily basis, 365, that will be 0.0082192. all right, so we're talking about 4 years. How many days there would be? 365 multiplied by 4, that will give you 1460. all right, present value right now is 1 million euros. Payment is 0. You will calculate CPT, future value will be 112,749.65. Now this is the compounding on daily basis, gives you a future value of 112749.65. We need to see the interest difference. Deduct 1 million from this amount and you will get 127,491.65. Now let us do it using continuous compounding. The amount is 1 million, e raised to the power, interest rate 3%, that is 0.03. How many years are there? N represents period, number of years, that is 4. If you calculate e raised to the power, what you will do in your BA2 plus, multiply 0.03 into 4, then press second and then press ln. That will convert e raised to the power 0.03 into 4 and then multiply the result with 1 million. You will get 1,127,496.85. Now what is the interest amount in this? Because we just have to calculate the difference in interest. Deduct 1 million from this initial investment. The interest is 127,496.85. So the difference between these two is a very small amount, 5.197, which is approximately B. So this is the difference between daily compounding and the continuous compounding, a very small one, $5 only on amount of $1 million. So that makes B to be the correct option. Next, an investment pays 300 euros annually for 5 years with the first payment occurring today. The present value of investment discounted at 4% annual rate is closest to. Now since it's the first payment is being received today, so it's an annuity due question. So I'm sure you know how to convert first into beginning mode. Second, the PMT key that has the beginning mode, then you press second again and then press enter or set. It will bring your calculator to the beginning mode. Period is 5. Interest rate per period is 4. Yearly compounding. Present value is to be calculated. Payment is given as $300. It's a payment negative and you have to calculate what future value is 0. You have to calculate the present value. So plug in all these numbers, you will get 1388.97. And please do not forget to restore your calculator to the end mode, otherwise the subsequent questions will get messy. So you'll do the same thing, second PMT, second set. It will bring from BGN mode to the end mode. So we got our result 1388 or 1389 rounded off. That gives B to be the correct option. Next, a perpetual preferred stock makes its first quarterly dividend payment of $2 in 5 quarters. If the required annual rate of return is 6% compounded quarterly, the stock's present value is closest to. Now interesting thing is that this interest rate has been given for the whole period. We need to convert it into quarter, but the first payment will be received in 5 quarters, right? Now let's say if this represents the quarterly timeline, starting from first, this is quarter 1, 2, quarter 3, quarter 4 and quarter 5 of the next year. We will receive our first payment as per the information, the first quarterly dividend payments of 2005 quarters. So when you will calculate the present value of perpetuity, the present value of perpetuity will calculate the present value at the end of quarter 4. Why? Because the first payment will be received at the end of quarter 5. So applying this formula, the return upon 6 upon 4, that is 1.5%. So 2 upon 1.5%, this will give you the present value perpetuity at the end of quarter 4. This amount at the end of quarter 4 has to be brought to year 0, right? So if the required annual rate of return is 6%, which has been converted to 1.5, how many periods are there? 1, 2, 3, 4 periods are there. Present value, that is what we need to calculate. 2 upon 1.5, that gives you 133.33. This is the value at the end of quarter 4. This amount needs to be brought in present term PV. There is no payment. Future value is 133.33, that has to be brought down in the present term. CPT into PV gives you 125.62, which rounded off gives you option B to be the correct option. Next, A saver deposits the following amounts in an account paying a stated annual rate of 4% compounded semi-annually. We have been given 4 payments for year 1, 2, 3, 4, end of year deposits. At the end of year 4, the value of accounts is closest to. There are many ways to do it. The first simplest way is that you can, since we have to calculate the future value, and the compounding is done on semi-annual basis, which means needs to divide it with 2, that is 2%. From year 1 onward till the end of year 4, how many compounding period would there be? Right? There will be 6 periods. There will be 6 periods, right? 1.02 raised to the power 6. For this one, there will be 4 periods, 1.02 raised to the power 4, 1.02 raised to the power 2, and this one is being received at the end of 4th year, so there is basically 0. Either you calculate these future amounts and add them up. This is the first thing you can do. Else you can use your BA plus, BA2 plus professional that can calculate your future value, and I'm sure most of you know that, how to do it. What you will do, you will first calculate your effective rate, 4% compounded semi-annually. Let me do it here. 4% compounded semi-annually. Nominal rate is 4. Compounded semi-annually. Enter 4.04. So you can use this rate 4.04 for your NPV calculations. You can take it into the future period 4.04%. So you can use your BA2 plus professional CF0, enter down arrow key 4,000, then you have 8,000, then you have 7,000, and then finally you have 10,000. Enter all these, press NPV, enter the rate 4.04, enter down arrow key, and then what you will do, let me do it for you. I hope the system is working okay. Okay. 0, enter. The first year is 4,000. Enter down arrow key twice. Then you have 8,000. Then you have 7,000. Then you have 10,000. $4.04. I think my tables were not cleared. We'll have an issue again. This calculator has some functional issues. Okay, enter down. See? Got it correct. Now, we need to calculate the future value. This is the professional version of your BA2 plus. Compute 3446. That's your result. B. B is your result. B is correct, right? So if you have your simple BA2 plus, what you will do, you will calculate your present value this way. This was your present value 25,986. This is your present value. Consider it as your PV. This is your PV. 25,986 is your PV, right? N is equal to, oh, just a minute, that was PV, 4 periods. Interest rate was 4.04. 0 payment. Compute 30446. So this way you can calculate BA2 plus or BA2 plus professional, whichever you have, or simply if you have the simple scientific calculator, you can use this way as well to get the same result, B. All right, moving on. Question number 20th. An investment of 500,000 euros today that grows to 800,000 euros after 6 years has stated annual interest rate closest to which? It's not a straightforward question. You can't solve it directly. it's basically trial and error type question. You will have to put these numbers one by one in order to get the correct result. I do not follow what is given the solution in the curriculum. I do not follow the solution. You should do your own shortcut ways so as to get a better understanding. So the solution in the, especially for this question, you can see the solution given is not correct one, because it's just guessing that this is the right compounding period and get the result. You have to have a good reason. So what you will do, you will use trial and error basis. First you will assume 7.5% compounded quarterly. If it is so, if it is 7.5% compounded quarterly, the amount should be equal to 800,000. So what you will do first, if you take compounded quarterly, in this case 0.075, you will use the calculator to calculate the effective rate. Using the effective rate, when you will calculate the future value, it will be 784,156. Had it been the correct option, you should have got 800,000 euros. It is not so. You then tried option B. Option B, using daily compounding, when you will calculate the future value using daily compounding, it would be 793,585. Right? And with option C, compounded semi-annually, using semi-annually compounding, it will give you 800,516. Now this is the option that gives you the most accurate result, because the solution given in the curriculum is not correct. It just assumes that this is the right option. You have to just use each one individually in order to determine the result. You can't just take one option and calculate the result. So 500 was converted to 800,000 at this compounded semi-annual rate. So this result is the closest to the final result. So that makes C to be the correct option. See, how can he say that it was done on semi-annually? Why did he use M2? Could have been 4, it could have been 12, right? No justification. He has just given this result and convinced you that's the right answer. There is no way for us to know. Just we can use trial and error basis method. We'll try each option and see which one of these gives you the closest result, and that is C, convinced. Next, question number 21. Sweepstakes winners may select either a perpetuity of $2,000 a month beginning with the first payment in 1 month, this is the first option, or an immediate lump sum payment of $350,000 if the annual discount rate is 6% compounded monthly. If compounded monthly, that means 6% upon 12, the relevant rate will be 0.5%. The present value of perpetuity is the return divided by interest rate. It is $400,000. Now either you have this option to take $2,000 per month for perpetuity, or you accept this amount, $350,000. Which of these is higher? Of course, the present value perpetuity is higher. It is not less than the lump sum. It is not equal to the lump sum. It is in fact greater to the lump sum. So the investor would consider this option because it gives you present value which is higher than the single amount of $350,000. That is C. At a 5% interest rate per year compounded annually, the present value of 10 years ordinary annuity with annual payment of $2,000 is 15,443. He has calculated present value of ordinary annuity for you, and it is equal to 15,443.47. What do we need? We need the present value of 10 years annuity due with the same interest rate and payments. We know the present value of ordinary annuity ordinary is equal to present value. I wrote it in another word. I need present value of annuity due. It is equal to present value of ordinary annuity multiplied by 1 plus R%, whatever the rate is being used. So we have 15,443.47 times 1.05. So ordinary annuity multiplied by 1 plus rate will give you the value of present value of annuity due, and that is going to be 16,216. That makes B to be the correct option. Question 23. Grandparents are funding a newborn's future university tuition cost estimated at $50,000 per year for 4 years, with the first payment due as a lump sum in 18 years from now. 18 years from now. So it's going to be something like this. Take a jump from 0, 1, 2, and then 17, 18th, because we will calculate the present value at year 17, 18, 19, 20 and 21. Since we need to make these payments of 50k each for year 18, 19, 20, 21, how much should we invest now? How much should we invest now so as these 50,000 payments could be made in year 18, 19, 20, 21? What we will do, we will calculate first the present value of all these payments using our TVM computations. So we have 4 payments to make. Interest rate is 6%. Present values to be calculated. Payments that we need to make is negative 50,000 in year 18, 19, 20, 21. Future value 0. When you enter all this and calculate the present value, your present value at the end of year 17, rather it will be PV at year 17, it will be, if I'm not wrong, this 64,340. No, this is the final payment. This is 173255. 173255. Now, this is what we need at the end of year 17. This is the future value for us now, 173,255. This is what we need at the end of year 17, future value, right? We need to calculate what should be the present value to be invested right now. So there is no regular payment, 0. How many years are involved? The periods are involved, 17. Interest rate per period is 6. We have to calculate the present value of investment, CPT, PV. You will input all the data and you will get your investment to be made right now. 64,340 if invested now will accumulate to 173,255 at the end of year 17, and this amount would be sufficient to pay $50,000 in the next 4 years, and that makes B to be your correct option. Question 24. The present value of an investment with the following year-end cash flows, 12% required annual rate of return. Quite a straightforward question. So I recommend to use your NPV function for this question like this. So CF0, enter down arrow key, enter $100,000, enter double arrow, enter down arrow key twice, enter down arrow key twice, press NPV, press 12%, enter down arrow key, CPT, and there you go. You get your result. That will be 201,747. Simply use your NPV function and you will get your results straight away. A sports car purchased for £200,000 is financed for 5 years at an annual rate of 6% compounded monthly. That means 6 upon 12, that'll give you 0.5%. 5 years will contain how many periodic payments? 12 times, that's 60. So N is 60. Interest rate per period 0.5. This is the payment that the cost of the car now. This is PV. Future value 0. If the first payment is due in 1 month from today, what will be the monthly payment? So basically, it's a leasing arrangement, so you just have to calculate the recursive payment monthly. All data is here. It's just a few seconds game, and I'm sure all of you are quite expert at it. It's 3866.56. That makes approximate B to be the correct option. All right, question number 26. Given stated annual interest rate of 6%, compounded quarterly divided with 4 gives 1.5. The level amount that given a stated annual interest rate of 6% compounded quarterly, the level amount that deposited quarterly will grow to 25,000 at the end of year 10. What do you need to invest now regularly so that if you make quarterly payments for 10 years means total 40 payments at a rate of 1.5%, PV0, what would be the payment made every period, every quarter, so that you get a future amount of £25,000? Simply input N40, 1.5, 0, and simply press CPT payment. You will get your result. That will be 461 straight away. Simple as that. Next. Given the following timeline at a discount rate of 4% a year compounded annually, straight 4% will be used. The present value as of the end of year 5, P5, of the cash flows received at the end of year 20. This cash flow brought to PV5. How many periods are involved? Straightforward. 15 periods. Simple, no compounding. It's simply 4% annually. We need to calculate The present value, not the present value, is PV at year 5, not PV at year 0. There is no payment. Future value is given as $50,000. It's a straightforward question. Enter this and straight press CPT PV and you will get your result. That will be 27,763. Last question, then we are done. A client invests 200,000 euros in 4-year certificate of deposit that annually pays 3.5% return. 3.5% annually of 20,000 gives you $700 every year per year. Don't forget that. The annual CD interest payments are automatically reinvested in a separate saving account at a stated annual rate of 2% compounded monthly. 2% compounded monthly. What will be the effective rate? You know the computations. Second, interest rate conversion. Our nominal rate is 2. Enter up. Compounding is being done on a monthly basis, 12. Effective interest is 2.018. So 2.0184 would be your interest rate for the period. How many payments are there? 4. Present value 0. We are interested in calculating the future value. What are the regular payments? Will be made 700. So for 4 periods, this is the interest rate. No present value required. Payment of $700 being made into an investment account. What will be the future value that investment account? So plug in the numbers and you will get 2885.919. But it didn't ask you to calculate the interest, the future amount of these payments only, because these are the 4 payments that have been invested at this rate. So this will be the future amount of interest only. We need the total combined amount. At maturity, the value of the combined asset inclusive of interest would be 20,000 plus this is 22890. I think we have got a marginal difference of $4. So that makes B to be the correct option. So gentlemen, that ends your, ladies, that ends your EOC questions. From next week, we'll be resuming from reading 8 probability concepts.